Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we had another successful Social Security workshop. We really pack them in, don't we?
Yeah, we do. And these classes keep getting more popular and more popular. And so we're blessed to be able to do a lot of great education events. In fact, we're going to have Mike Schudel stop in here a little bit later this morning, and we'll be talking about the next class, which is the estate planning class, which is actually probably the most popular class that we hold. So pay attention for that coming up. But absolutely. And But a lot of folks got some great information. Sean Swanson taught the Social Security class we had here this past week and was very well received.
And then we'll also have Colin Kastrick, the estate planning attorney with whom we work. He'll be joining Mike Schudel for that estate planning workshop. As David said, in the next segment of the show, he and Mike will get into more detail on that. It is good to see, David, people are getting the message. An estate plan is a crucial part of your overall retirement plan.
Absolutely, and it's not, a lot of people misunderstand that you have to have this great wealth to need an estate plan. No, honestly, everybody needs to have this done because it's your intentions and your wishes. And if you still have minor children, who's going to care for them? All these things. There's so many factors that go into it.
All right, David, let's get to the financial news. You said in a recent team meeting here at Retire Smart, there was a recent, you called it a pop in the market, but you said this is really like another one of those sugar highs. Tell us what you meant.
Well, you see the market came out of January here and went up about 3% or so off the, in the first couple of weeks. And so people are like, oh, look, it's all good. It's all clear. In fact, we had some advisors in for the tax mastermind from across the country. And I was going through some of the recession data. And they're like, well, they were kind of fascinated by some of the data we show and talk about why we think what we think. And it was opening some of their eyes because a couple of them, unfortunately, work for some of those cookie cutter style firms, if you will, and are just told the same thing that we joke about. Hey, just hang in there. It's all going to be fine. And unfortunately, I don't think that's the case. So, yeah, this little bit of a pop or sugar high, especially in some retail stocks. So I don't want to name names or whatever because we don't make specific recommendations, but a very popular online furniture retailer stock popped the other day in what was called a short squeeze. In other words, people that have been making money when the stock fell, and hedge funds typically are the ones doing this, made a bunch of money. Well, they have to eventually purchase the stock back. They sell it first and they buy it second, right? They just do it in the reverse order. So they're hoping to sell it when it's at a higher price and purchase it back at a lower price, and they did that. But when they cover the short, so to speak, the stock has to pop because there's a ton of volume funneling through there. And we've seen quite a bit of that. And then as earnings have come out this week, they've not been rosy. So we just saw, Mr. Softy, Microsoft, one of the biggest tech companies in the world, just report earnings, and the stock did not behave very friendly this week. And we're seeing that across the board, and we're seeing them all lay off jobs. As we've mentioned, about 250,000 job layoffs just in the tech sector alone have already happened, and we think there's more to come. So, yeah, not a very rosy picture for the economy.
Well, and we had a dose of reality. You alluded to it before, and it finally happened. Here's the CNBC headline. The U.S. hit the debt ceiling. Here's what that means for your money. Well, first of all, David, what does it mean for our money that happened?
So, it means we can't run the credit card up, so to speak, anymore unless Congress says, okay, we're going to approve a new limit for us to be able to spend money. But where do they get the money, Chip?
Well, ultimately, it's going to have to come from us.
Well, yeah, exactly. So what they're doing is effectively printing money or digitally creating it when they say we're going to raise the debt limit to cover spending they've already legislatively agreed to spend. Now, that is not fiscally responsible, and of course people can wake up to this, but we've done this over 60 times, and it's become the norm, but it shouldn't.
It's a farce to call it a debt ceiling when you just keep raising it. Whatever you get close to it, it's just more borrowing, more. And, I said that we'll have to pay for it. It's actually our children and grandchildren that are going to be stuck with this tab.
Well, absolutely. We're at $31.4 trillion on this limit on the company credit card, if you will, here for the government, and they want to push this up to fund pass. And of course, what happened here is they pushed through a $1.7 trillion ominous stimulus bill right between Christmas and New Year's while everybody's on vacation, and then that made us hit even faster, right? So this was forced upon us, and they were not willing to actually go in and cut all the pork that was in that bill. And we talked about a couple weeks ago, all the different stuff that was in there. You're paying to study roaches if they like music and some other things. If people really dove in, they would get upset. But I also talk about the reality is defense spending and the major what we call entitlement programs, Social Security, Medicaid, and Medicare. Those 4 line items are about 84% of the budget. So there's not a lot of wiggle room, if you will, for them to cut this. So what are they going to do? Well, they're going to keep raising the debt ceiling here, but then ultimately they're going to come for you and I to put the money back in the coffers via taxation. I mean, that's just a reality. And if we don't pay our bills, what's the downside? Well, if we don't pay our bills, if we default on our debt, then our credit rating, which has only been downgraded once in our history, and this happened about a decade ago when we had this debt ceiling fight back in 2011-12 time period, you could downgrade it, which means you'd have to pay more in interest to get somebody to buy your debt. And, cities and municipalities are going to go through this pain here over the next couple of years. They've been borrowing money. Even here, I've been a critic of the city of Omaha borrowing too much money for certain things like the streetcar and, the float bond issues to, we did $250 million here to do road maintenance. Instead of just doing $20 million a year, which is what the maintenance costs, we spent $250 million up front, and we're going to pay interest on that for the next 30 years. That's not fiscally responsible, nor is this raising the debt ceiling. Now, political opponents on each side will try to frame this as they can. The Republicans, we're going to hold the line here, and yada, yada, not really. And then Democrats, if we don't get this raised, they're going to cut your Social Security check. Are they going to cut welfare checks to illegal immigrants? They don't mention that.
Right. No, you lead with Social Security.
Yeah. So they lead with stuff. And that's nonsense. They're not cutting anybody's benefit. Unfortunately, we talked about it, I think, last week, is they're going to furlough some government employees, send them home, put them on a vacation, while they argue this out in front of the news for 4 to 6 weeks. And those government employees are not going to do anything and sit on their thumbs or whatever, go on vacation. And then, we brought them back. Now we're going to give them back pay, even though they didn't do the work.
Being a paid vacation.
So I think government work should come with a contract. You have to work even if you don't get paid during these times, and stop the nonsense. But again, it is just nonsense.
Hey, David, the Motley Fool had something. You've been on this for the better part of a year, the yield curve and what it tells us. Here's the headline. This recession indicator hasn't been wrong in 56 years, and here's what it says happens next. Can I take one swing at this, and then you can clean it up if I make a mess of it? Well, the idea is that in typical economic circumstances, long-term bonds have a higher yield than short-term bonds, which makes sense. If the government's going to hang on to your money for a longer time, you ought to be compensated at a higher level for that. But what we have seen is short-term bonds with a higher yield. Well, that means things are out of whack. I'm going to stop right there and let you take it from there.
Well, yeah. So the spread that most folks are monitoring is what we call the 2-10, the 2s and 10s. So the 2-year Treasury, how much money the government will pay you to finance them for 2 years. So if you wanted to buy a 2-year Treasury, right now they're paying you well over 4%, about 4.2%. A 30-year Treasury, they're only going to pay you about 3.4%. So you'd get paid more interest to give the government a loan for only 2 years and get your money back versus giving them a 30-year obligation, or a 10-year, not a 30-year. And so what happens here is that's called an inverted yield curve, and that has been 100% accurate. We've not had this big a spread. It hit over 80 basis points recently spread between the 2 and 10. We haven't done that since 1981. All right, and 100% of the time it's predicted the last 5 recessions, so my entire adult life it's been perfectly accurate. And as it says, it tells it there's going to be a recession within 24 months once the yield curve inverted, and you go all the way back till 1960 for that data.
Well, but here's the ominous thing. So this article cites some of those previous historical examples, but in the past, the Fed has come rushing to the rescue by lowering interest rates.
And they can't do that this time.
That is not going to happen this time.
No, and that's why the recession is going to be a little deeper than anyone's talking about. Everybody keeps talking about this Goldilocks. We're going to achieve this soft landing. That's not really in the cards, at least not if you study history and believe that, history does repeat itself, right? So you better learn from it or you're going to make the same mistakes. So we are going to have a higher cost of borrowing for businesses. Therefore, they're not going to be able to do economic expansion as fast as they want to, Chip, which means the slowdown won't get over with quicker. So what you're going to see is the Fed, which is still going to raise rates a couple more times here. Now, a bit smaller rates, probably quarter-point hikes next couple. But then they're going to pause, not pivot. Again, they're going to pause, not pivot. They've never pivoted. However, if you look at economists, they believe they'll go backwards 200 basis points or the equivalent of 8 quarter-point cuts by the end of 2024. Now, I don't know if they'll do that or not, but I don't see them cutting before November of this year. And that is going to be a problem and why this recession is going to get deeper because it's going to be more layoffs. We've been talking about that. And we're going to have corporate earnings get crunched, and we think the S&P 500 can earn less than $200 this year as a collective unit. And if you use a traditional metric, and again, we're not trying to tell you where the market's going, but it usually trades somewhere around 17 times earnings, Chip. So what's 200 times 17?
You'll have to do that one.
That's 3,400. All right, I know it's big math here. I had to take off my socks and shoes, but the S&P is trading around 4,000 as we record this show. So a fair value of the S&P on those earnings later this year is 3,400. That's a 600-point drop in the S&P. That's over 15% from where we are now, which is down about 20% from the highs a year ago. That will be pretty painful for a lot of people if they are not prepared. And again, no one has the great predictor. We don't have a crystal ball, but the data tells us what we think the high probabilities are, and we want to show you how to position your portfolio accordingly. Get a complimentary risk analysis. It's part of our report
card. The report card, you don't need a crystal ball. That's what the report card is for. It's a comprehensive review of your entire financial situation. Maybe you're in great shape. Maybe you don't need to make any changes. It's more likely that maybe you do need to make a few changes. That's okay. We're in unprecedented times. The point is, find out now, and let's be, as David says, let's be proactive and get moving on it. The complimentary report card, 402-369-7777. 402-369-7777. No charge, no obligation, complimentary report card. 402-369-7777. Up next, David Brooks is great, but it takes a team to do what we do at Retire Smart. We welcome back to our show a vital member of that team, financial advisor Mike Schudel, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our special guest this week is an experienced financial advisor who also is an attorney, a certified financial planner, and a finance teacher at Creighton University. He's our go-to guy on estate planning, and we're glad to have him back for another visit. David, please introduce our special guest.
Thanks, Chip. Yeah, we've got our favorite advisor to have back in on the show. He's been working with me longer than any of the other advisors here at Retire Smart, and he's got all these different letters behind his name, and we'll put that up later on the show. But Mike, listen, you went to law school, and so we always like to bring you in when we're talking about estate planning, and we do have an estate planning class, folks, coming up, and that's very popular. So we'll tell you how to get signed up for that in just a few minutes. But Mike, hey, first of all, thanks for taking time to jump on the show with me this week.
It's always a privilege.
So what I want to talk about is two main things I'd like to kind of just cover in our short time together today. Is one, we've got some good news on the inheritance tax. The bad news is, yes, we still have one here in Nebraska, one of only 6 states, but the thresholds have been moved up in our clients' favor. And now with proper planning, we can really help avoid that for a lot or a majority of clients. But what I really want to dig into, Mike, is we got a lot of folks that have really elevated real estate values right now.
Yeah.
And that tide is turning as we speak. In fact, there was just a recent article out by an analyst that just predicted a 25% decline in at least the 4 major cities that have had the fastest growth. And he was talking about cities like Austin, Texas, and Phoenix, Arizona, and Miami, Florida, et cetera, referenced in there. But nationwide, he, along many analysts, believe real estate will have to go backwards 10 to 15%. And that's a big number. And it also creates a problem, what we call the wealth effect, where people feel less wealthy, right? The value of the house. But what I would like you to talk about is how the estate planning class could maybe help people understand there are ways to start setting up and positioning asset transfers. Maybe you have a family farm, maybe you have a couple of rental properties, even if you inherited those, and your plan is really just keep them in the family and pass them down. Unfortunately, with the estate tax issues that are coming our way in less than 3 years, the changes to the law, without planning, a lot of these folks might end up being in for a bit of a bad surprise, right?
Absolutely. Well, I mean, with all the spending that the government's been doing over the last 36 months, they are going to be looking for some additional revenue, and taxes have been and always will be the easy button to hit on that.
Well, imagine this. The government likes to just keep pushing the envelope on this debt ceiling. Like, imagine if you have a credit card and you've hit your limit and you decide to call up the credit card company and say, listen, I'm not giving you an option. I'm raising my limit. And then I'm not going to pay you back, but I'm going to rob my neighbor to make my minimum payments. That's kind of what we have going on right now with the debt ceiling, right?
Kind of flies in the face of what I was told were American values, but hey, that's the way it's going to run for our government. But let's be proactive in how we can help the people listening. A lot of these properties, the real estate that a lot of our clients come in owning, it's really precious to them, whether it's a family house that they inherited that they've wanted to continue to renovate and keep in the family, or more commonly even than that is rental properties or a farm.
Absolutely. And we want to help them understand that not only do you want to make sure that these assets transfer to who you want properly, and man, I got to tell you, what's scary, folks, and if this is you, shame on you, they don't have beneficiaries, right? They don't know that, like you have an IRA or a bank account, you could have a beneficiary listed on this account, but your real estate, you really don't have a beneficiary. So you need to understand why, and this is what the estate planning class really is. It goes through the basics of titling assets, how you can actually pass the assets, the proper documentation. But in particular, as you said, we're talking about property that's maybe not your primary residence. So it's exactly a rental house you may have had for a while, a family farm that you've had in your family for generations. There are inheritance and estate tax issues that are coming up. So let's just talk about your family, right? Your family was blessed to acquire some assets and a family farm that you were involved in here recently, right?
Absolutely. One of the greatest privileges of my life is I was gifted the family farm that's been in our family for over 150 years, and I will never let that pass. While I own it, to any other owner, I'm going to make sure that it travels through the bloodline. But listen, folks, it had to be passed down in a very deliberate, very well thought out manner, because if you just let these things happen, the likelihood that your beneficiaries, your loved ones down the road will have something blow up in their face, specifically taxes. Real estate is not a liquid asset, and coming up with the money to satisfy those taxes, oftentimes without proper preparation, requires liquidation of that property, and the whole thing just falls apart.
Now, folks, this matters if you own a business too. Maybe you have a second generation family business and you'd like to pass it to the third. Many people don't understand the valuation of that business is under those same inheritance and estate taxes, and this class will address some of that. So if you're wondering how to pass these assets or what you can do, and could you gift them? And a lot of people don't understand, Mike. Somebody can gift you, as in your family, you had your dad in this example, and I think he's okay with saying, gift you the family farm that went to him. But it was so important that he did this now, before the estate tax runs out here, because in less than 3 years, he would not have been able to do that.
Yeah. Listen, folks, I appreciate that I've been through the training at law school to understand this stuff, but this can be really intimidating if you're just hearing it. Well, what about me? How do I get all this unraveled? What do I do? It starts with getting educated, and that's what we try to do at these seminar classes. We aren't here to sell you a thing. We are here to give you value and information. So if you come, we are going to give you some of the basic information so you feel empowered to be proactive in your own situation. You'll know who to contact if you want to take it a step further, and you'll just feel so much more confident that you got a plan.
And so the estate planning workshop is coming up. It is going to be put on with Mike Schudel, here, one of the advisors in the office who has a law degree, but also Colin Kastrick, a local estate planning attorney that we've referred a lot of folks to that's well-versed in this as well. So the two of them teach this class together. I do believe we have two opportunities you can take this class. It's either going to be Wednesday, February 15th at 6:30 p.m. at the Midwest Learning Center, or Thursday, February 16th at 6:30 p.m. You don't have to go to both. It's the same class both nights. We just try to make sure, because we do get the rooms get pretty full. But also, people that need to come to this class is if you're wondering, do I really even need a will, right? A lot of folks that just have a pretty basic estate. I got my house, and maybe you can transfer that on death, and maybe you don't, but that is something you can do here in Nebraska. In about 25 states or so, you can do that without going through what we call probate. And then, but your assets, why it's important to have all the proper documentation, from a healthcare directive, a financial directive, HIPAA releases, all kinds of things can be covered at this class. And then and you and Colin kind of go through that. But I mean, everybody really needs an estate plan.
Yeah, I'm glad you brought that up, David. I don't want the audience to think that this estate planning seminar is something just for people with property or what have you. The workshop is designed to help people just get a basic understanding of estate planning, wills, trusts, powers of attorney. We start with the really basic stuff. That's where we want to start with. And then if you need to take it a step further, then we'll give you the resources and contact information on what to do about that.
And there's huge opportunity here to make sure that if you haven't done something, you can get a complimentary consultation with the attorney Colin Castrick after the event. There's no obligation, of course, to do that, but to understand what you might be missing. And of course, he'll review their current setup of documentations, and he does this for our clients on a regular basis. The other thing I would tell you too is if you're not doing something on the regular, one of the things we recommend, and we do it with our clients, is do what we call a beneficiary review. It's so important to make sure your beneficiaries are in line with who you believe you still want on there. And you should do this about every 3 years, because let's face it, stuff changes, right?
Absolutely.
I just actually had a review, and I was in the office yesterday and had a review with a client who's been a client for a while now, and they don't have any children, right? And this, unfortunately, is several clients we have this. And so who they're going to leave it to is typically their siblings. Well, they're getting older and older, and their siblings are getting older and older. And one of the frank discussions I had yesterday was somebody was like, well, your brother's 7 years older than you are. Is that who you really want to leave this to?
Yeah.
Or do we want to go ahead and leave it to his children or even his grandkids, et cetera? And they're like, yeah, we have actually great grandnieces and nephews now. Maybe we should start talking about how to pass that, because they won't run out of the money, the folks that they had, what they had. And so what do you want to have happen? What do you want the design? And that's what the class is really about, is thinking about the outcome if you're no longer here. And folks, first, it's spouse to spouse if you're married. And then there's critical bits that Mike covers, which is very common today. What if you're cohabitating? In other words, very common for people that maybe just didn't want to get married again, right? Unfortunately, had a divorce or widowed and found a new companion in life and living together. We have a client that's been together with each other for 17 years, but they are not legally married. And that creates a huge tax problem here in the state of Nebraska. You think you want to leave your beneficiary the house or the IRA or whatever. Oh, I just want, and do you know about the 18% tax you might pay?
Yeah.
And so those things are covered as well. So in a nutshell, folks, if you've just never kind of taken care of this stuff and you want to find out what's going on, we'll highly encourage you to come to this. So, man, time flying here, Mike. I guess we're out of time for this already. So when is the class coming up again there?
Yeah, it's going to be Wednesday, February 15th or Thursday, February 16th. That's here in our Midwest Learning Center at 6:30 p.m.
So if you can just give us a call at 402-369-7777, and we'll be happy to get you signed up for that. Mike, thanks for taking time to stop in, man. Have a blessed week, brother.
Thanks, brother.
All right, Chip, what do we got next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about retirement income. My husband and I are in our early 50s and plan to retire in 15 years. We figure we will need $6,000 a month in retirement. How much money do we need to save to generate that income stream for perhaps 25 years?
Okay, so that's a good detailed question. So I like where their head's at. They're thinking this out. So number one, you need to have a written income plan so we can really figure that out. And then we need to understand where that income is going to come from. So Chip, I talk about all the time, there's only two kinds of income. I keep it really basic and simple. Growing up on a farm, kind of like simple analogies. There's guaranteed income and there's non-guaranteed income. And obviously, we'd all probably prefer to have more guaranteed income in reality, but that's not going to be the case for a lot of us. So when you retire, and basically you're going to retire in about 15 years. So they said they're in their early 50s, so that would mean late 60s, right? So full retirement age for some of that guaranteed income, a la Social Security, would come at age 67 unless something changes in the legislative pact between now and then. So you will have husband and wife that have Social Security 1, Social Security 2. So they're going to have two guaranteed checks that hit the bank account every month. They may be blessed, they did not give us this information in the question, but they may be blessed to have some other guaranteed income like a pension, right, from a work or government employee, et cetera. And then they may have some what we call reliable income, maybe not necessarily guaranteed, but solidly reliable. I'm a big advocate for things like rental income from, passive investments like real estate. I own those. We talk about that a lot. So you may have that. And then we're going to have the gap. right? So, and again, I don't have all the answers here, but basically they want to retire on today. Now, here's the other thing that a good financial planner will do, Chip, is $6,000 today is not $6,000 15 years from
Better
now.
factor in inflation.
So if you run at our current inflation rate, you're going to need closer to $11,000 a month to retire at 67.
That's almost double.
Well, when we're running 6% inflation, so absolutely.
Yeah, okay.
Now,
All right.
now we use, just so you know, when we are typically using these calculations, we use 40-year historical inflation, and it's up over 3.2% now. So, including last year and including Jimmy Carter years when I was getting out of high school, et cetera. When interest rates were high. So we're going to use really long-term data because you're going to go through ebb and flows of inflationary periods within the economy. That's just the way it's going to work. So we would accurately tell you what your income would need to be day one of retirement, and then we're going to have a written income plan where we're going to show you those guaranteed sources on the left side of our income plan, like Social Security or pension, what have you. And then on the right, we're going to show you the variable income, which would come from your portfolio, the stuff you're going to save, right? And this could be in the form of dividends, interest, or just selling off assets, et cetera, depending on how somebody was set up. But more importantly, what we've got to do is, do you want that to spend, or is that your gross income estimate? So these are really serious questions because tax rates may be different. In fact, we know they'll be different in the future. They're going to change in about 3 years. So what we have to do, and what I always kind of just ask is in the conference room, what do you need to hit the checkbook, just net after-tax money to live on every month and feel comfortable? What's that number? And if that's $6,000, in today's world, we'd have to gross that up. 6 times 12 is 72,000, right? And then if that were taxable income, then you're going to need to pay the Fed and state if you're retired under current law at that time period, that would be a 15% federal tax bracket. Again, that could be higher. It's 12 today, by the way, but it's going to go to 15 in less than 3 years. And then we have the state of Nebraska gets about 7 as well. So roughly 22% tax. Well, if you need 72,000 and you got to send at least 22% on top of that grossed up, you're going to need close to $100,000 in income. Now, to generate $100,000 in income, again, how much of that is guaranteed and not, we have to go in and factor that in, and how much of that's guaranteed. Let's just say they had $50,000 that guaranteed, Social Security, whatever it might be. We're going to solve for the other part, and then we would show you what you would need to have exactly in your portfolio, and we start with what you have today, what rate of return you need to get between now and then. And here's the good news. Some people don't need to take excessive risk to get there. Once we show them an income plan, it helps drive your methodology and how you should be investing your dollars, because most people, frankly, Chip, and they found it out last year, some of the listeners of our show, they're taking too much risk. And again, this is why a well-rounded plan that's going to cover a written income plan that's inflation adjusted, risk management on the assets you're acquiring or growing to meet that income need, and we have to change the way they're invested when you flip from accumulation to decumulation, and then we got to address taxation. So there's a lot to unpack there. That would be a great candidate for the actual report card that would cover all of those factors.
So you can't really, well, you need $1 million or you need 1.2 million. Well, no, we got to know what the different sources of income are. There's so many factors. It's hard to just give one number.
Yeah, and there's this old adage called the 4% rule. We don't believe in that. So
right.
You could pull 4% of your portfolio. So if you had $1 million, your income starting in retirement would be $40,000 in that example. But if you don't understand risk management, as we actually show this in some of our classes, you'll run out of money in the last 23 years. You would literally be out of money this year if you retired 23 years ago with $1 million and followed the 4% rule. If you were just leaving it in the stock market and because of the ebbs and flows and the ups and downs, and that didn't even mitigate taxation or these other issues or what ifs or outliers, emergency accounts. There's so many factors into a true holistic plan. We call it the SMART plan. That's our proprietary planning process here. But whoever you're going to use, again, I highly recommend that you use independent-based financial planners. We prefer if you use what's called a fiduciary. They just have to, they operate to a higher standard than somebody who works off of what's called a suitability recommendation. There's fine folks in all avenues here. But again, that's just my personal preference and my opinion who you should work with. We'd love to let you go through our SMART process here and find out via the report card if we're the fit. But even if we're not, make sure who you're working with is going to address all those key areas.
David, here's a 401k question. Why are there limits on contributions to a 401k? Why can't I put as much as I want into my 401k?
Because the government needs your money, your taxation, your revenue. So they limit how much they let you defer, which we just had a big increase, by the way, this year, the biggest one in a long time. So they if you could put your entire paycheck in there, if you didn't need it, you wouldn't have to pay tax on that if you're putting it in a deferred account. The government says, no. We're just talking about the debt ceiling, buddy. They've got to operate. They need operating revenue, so they've got to have you pay taxes each and every paycheck. And so that's why there are limitations on how much they will let you defer. And so it's really simple. It's an actuarial calculation. They will only let you defer a percentage of your income up to a maximum. Now, in a 401k, that's real simple limits. There's the limit for those of us that are under 50, et cetera, and there's catch-up contributions. But if you're self-employed, there's a whole nother gamut of things you can defer a lot more money if that's what you want. We have entrepreneurs that can defer up to $250,000 a year if that's what they need. Again, may not be the right choice because we think tax rates are higher in the future. Why would you want to defer a tax today that you may have to pay a higher tax again in the future? All those things have to be factored in. Great question, though, but it's simply government wants your money, buddy. Time to pay the piper.
David, a Social Security question is next. I was not able to make it to your Social Security workshop. Can you summarize what was presented? Oh, my goodness, that'll be a whole other show unto itself.
Yeah, so let me just be honest and say no, I wasn't there either, all right? So Sean Swanson, our advisor who was on the show last week, actually presented the class. It did go over very well. And we will have this, just so you know, we do these about every 2 months, so we rotate all the classes through. So I would advise you to call after today and just get on the list. We'll remind you when the class is. I don't have the date in front of me as we speak, but in general terms, we go through how Social Security works, right? How it's calculated. Average 30, your highest 35 years is the number one factor. Do you work for 40 quarters or the equivalent of 10 years? Are you married? Are you single? Were you married prior and did not remarry? These are all factors in how you would withdraw Social Security. Do you want to draw at early? Do you want to draw at full retirement age? Do you want to let it defer as long as you can, which currently is age 70? All these factors are covered in there. And then really what's important there, we also cover in there is how much will you get taxed on said Social Security? Because, again, we were all promised way back in the day by FDR, this will never be taxed. That's just not true, unfortunately, for most people. But about 40% of the people that we show them how to do this, they do get their Social Security tax-free, Chip. So really key to understand, we talk about how to maximize it, number one. That's how to get the biggest bang for your buck out of the government from the money you've invested in this program, getting it out. But number two, we're going to show you how to optimize it, mitigate taxation. And the mistake for a single person can be between $50,000 and $90,000. For a married couple, could be up to $200,000 mistake. There's over 500 combinations and different ways that Social Security, disability income, et cetera, can all be withdrawn for a married couple. The idea that you choose the exact right maximum strategy for yourself, or it's almost impossible. So, and we're not going to be for sure unless we know. If you can tell me the day you're unfortunately no longer going to be here, we can dial it right in. But we have to make a best guess on all the pertinent information you give us, longevity, et cetera. But we would highly encourage you to come to the next class. But even better, just call in and talk. Get a 15-minute phone call with one of our advisors. In fact, if you want, ask for Sean Swanson, who taught the class, and we'll be happy to schedule that for you.
Well, David, since we're out of time for Q&A this week, how many of those openings do we have this week for a 15-minute phone conference with one of our advisors?
We have 8 of those available, so I'm happy to know that our capacity's increased a little here lately, so we can do 8 of those because we now have 8 advisors on the team. So fantastic.
So if you're antsy about Social Security and don't want to wait for the next workshop, give us a call, 402-369-7777, and you can set up a 15-minute phone conference, ideally with Sean Swanson. He's our go-to guy on Social Security. Now, you can get the report card, too, because, David, correct me if I'm wrong, but a review of your Social Security situation and our recommendations, that is part of the report card process.
Absolutely. That's the S, which is sources of income, where we talked about earlier, guaranteed, non-guaranteed. We're going to look at all the sources of income you have, and we'll answer those questions.
So we've got 8 openings for a 15-minute phone conference. If you want to just dip a toe in the water, 402-369-7777. If you want to take the plunge and get the report card, that also is 402-369-7777. Up next, when it comes to withholding from your 2023 wages, make sure you get it right because Big Brother IRS will be watching. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, when I see the word surprise in connection with the IRS, that usually doesn't bode well. Here's the headline from the Epic Times. IRS reminds wage earners to adjust 2023 withholding now or face a surprise later. What is the situation here, David?
All right, so we just had a change in the income brackets. We had a pretty good inflationary bump in how much income you can have in each bracket, number one. And so this will change the withholding calculator based on what you make. So your paycheck may start withholding less than it did last year. And if you were, let's just say you file your tax every and you were getting a $2,000 refund back. Well, if they're withholding less, that may not be the case next year. And if you're expecting that refund, it might be I owe $500. I thought I was going to get about $2,000 back. And unfortunately, many people use this as a savings account. And I understand if you're an undisciplined saver, then this might be a okay way to do it.
They've got it backwards.
Yes.
You're letting the government have too much of your money all year long.
I can give an example. My wife, one of her best friends, was a single mom, unfortunately was divorced, but had 6 children, and so through various tax credits, et cetera, would get a very large refund back every year. We're talking $8,000 to $10,000 consistently, and my wife's like, "Why does she get?" I was like, "Well, that's our tax code. We give you credits for these kids," but the problem is, she's giving the government an interest-free loan while paying a mortgage and a car payment. She could have had $1,000 a month more if she had her withholdings correctly set up, coming to her monthly budget, and could have reduced interest payments and debt reduction vastly instead of blowing it on a vacation account or something like that. So it's about financial discipline, financial literacy. And so the IRS has gotten a lot of complaints over the years, and especially from guys like me. I never want you to give them an interest-free loan. In a perfect world, Chip, now listen, taxes are due and owed in the quarter you earn them. So you can't just not pay taxes and at the end of the year send a check in. You can actually pay a penalty on your taxes if you wait. Now, technically, you don't file your taxes. You have up until April 15th or April 18th this year because of the holiday to get them in. But if you earned, let's just say your tax bill last year for simple math was $20,000 to the federal government. If your tax bill this year is more than 10% higher or 110% of that tax, so over $22,000, and this happens to folks that work in like commission-based sales, so realtors and mortgage brokers, where their income might spike in one year. If they wait to the end of the year to file their taxes and it went up too much, they will actually pay a penalty on top of the taxes. So understanding how to, and quarterly estimates can eliminate that, and your accounting professional can help you with this. It's called the safe harbor rule. But what we want people to understand is, unfortunately, the ones that are going to get hurt, and this article references a bit of it in there, Chip, is our lower income earners. During some of those COVID stimulus bills, we increased the child tax credit to $3,000. That's gone. And so people are mistakenly not understanding some of their paycheck that they're actually walking away with right now should go back to the government. And so, unfortunately, a lot of folks that earn under $50,000 are going to owe $2,000 or $3,000 more next year than they're prepared for when they have kids, and they need to make sure they go to the calculator. And the IRS, it's on their website, irs.gov, and you're just looking, and they have a search bar, and you can the withholdings calculation estimator, so that you're claiming the right amount. And then you would just get with the HR department at your employer and make sure you're withholding on your payroll the correct amount. Again, I want you to come in within about $1,000 either way is what I usually tell clients. So that means we estimated correctly. But if you're getting this massive refund back, Chip, exactly, you gave the government an interest-free loan. Unfortunately, they don't pay you an interest on that money, do they? No. But if you owe them, they expect some interest. And the other way around is don't get surprised because you owe more than you thought. But either way, it's about planning, financial literacy, which again is why we do so much education. One of the reasons we love to do this show.
David, you mentioned layoffs earlier in the show, especially in the tech industry. CNBC headline, Google employees scramble for answers after layoffs hit long-tenured and recently promoted employees. So this wasn't the typical, last one hired, first one fired scenario. These were some senior people, some long-term people that were laid off by Google.
A lot of disgruntled employees across the bow, firing shots on social media, et cetera, back to the CEO. And exactly, you know what they did is they went in and they cut. Number one, they cut significant amount of remote workers that wanted to stay remote. We've talked about this. And number two, they targeted higher earners because this is the biggest bang for the buck. The CEO's got to drive down costs. And so senior employees that thought they were safe because they weren't the newbie got cut and were surprised by the move. The point being here is, folks, layoffs are coming, whatever industry you're in, across a lot of industries. And we've had such a robust job market, people kind of have forgotten how, what it's like to work in a different labor market. Well, a year from now, we're probably going to have a very different labor market than we have today. Unemployment is still below 4% nationwide. I don't think that'll be the case at the end of the year. I think we'll be 5.5% or higher potentially. And that is a significant shift in the job market. And these folks in the tech industry, not just Google, but Microsoft did it, right? We've seen Spotify just fired a big chunk of it. These are people that have generally getting paid in an above average wage. And all of a sudden that's gone. And some of the perks, and Google was known for a lot of perks, right? Apple didn't have to lay off as many because they're not quite as frivolous with their spend for their employees. They actually make them pay for certain things and what have you. So some of these companies that were, they were trying to attract talent. That's the name of the game. And so they were a little zealous with some of the benefits and the perks they gave. And so now they're cutting them back and they're trimming the cost. And even my own wife, we provide like snacks. We have a snack bar here for the employees. And I got to listen to my wife when we make the trip every month to Costco and load up on all the snacks. And, I'm like, honey, this is a great benefit for the employees. It makes them happy and motivated, et cetera. But companies are going to have to make these decisions, and they're realistically looking at stuff and saying, hey, we got to cut costs. And so make sure you're dotting your I's and crossing your T's where you're employed right now if you're fearful of that. And we think you're going to see a wide range of layoffs in retail, in distribution. There's a lot of other areas that's going to get some dynamic job layoffs here in the coming months.
Well, I'll have a whole new appreciation for those Fritos, Doritos, and Cheetos. Thank you very much. Hey, listen, David, we were talking before about long-term financing and the debt ceiling and the borrowing, and I think the way you put it was you're going to have to pay the piper someday. Well, that someday is coming in about 10 years, it looks like. That's the latest on Social Security. This is from Fox Business. Major Social Security trust funds could be tapped out by 2033. That's according to the Congressional Budget Office, which is usually considered a nonpartisan, neutral analyst. Something's got to give here, David. Either the benefits will be reduced or the taxes will be raised, but business as usual just isn't going to hold.
You bring up a great point, Chip. So we can kind of get into the analytics of this. And by the way, they run a 75-year forecast for this actuarially. That's the way they do this stuff. And so, but do you think benefits will be cut or taxes would be raised? Which one are you going to bet on there?
I know my bet will be placed on raising taxes.
Right, because no one is going to vote to take away a benefit from a voter, right? No one, so no congressman, whatever party is going to take money away from grandma or whatever. They'll show those commercials of Paul Ryan taking somebody off the cliff, right? We saw that with the ACA, et cetera. So the likelihood is what they're going to do is, and this can be solved, by the way, okay? And this is one of the things, I haven't taught the Social Security class here for the last couple rounds, but I go through it, and I think Sean does, and I'll have to ask him because I don't know if he did it last week. But we have what I call a barbell generational system. A picture, a big weightlifter lifting up this gigantic Olympic barbell, 500 pounds on each side, but the skinny bar in there. Well, on the far right side of that barbell, the little part is the greatest generation. Those folks are 83 plus years old today and are not a burden on the system because there just wasn't that many of them, right? Because when Social Security was enacted in 1935. Then you've got your folks, Chip, the baby boomers. Sorry, putting you in there. The baby boomer group is the largest generation. There was over 88 million boomers born in this country, and those folks were born basically from 1945, right after World War II, to about 1965. And that's who's draining the system and the problem today. We have over 10,000 people turning 65 every single day, and we got another 8+ years of this math to deal with. Then you get, though, to the middle, the bar, it gets skinny again to my generation, basically Generation X. We are a much smaller generation, about half the size of the baby boomers. This in lies the problem, is we're not able, my taxes, even though I pay plenty, are not enough to funnel the benefits going out the door to take care of baby boomers today. But behind me, and nobody talks about this in politics, is the next generation. And it's even bigger than the baby boomers. Over 96 million millennials were born in the following generation. And the oldest millennials, they're in their 40s now. They are starting to earn good income, and they are paying into this system. So while Social Security will have to cut benefits or raise taxes, and we both agree taxes is what they're going to do. We don't really think they'll cut your benefit. But they actuarially, the CBO has got his responsibility to tell you that they're going to have to cut the benefit by about a quarter in 2034 if nothing were to change. Of course, something will change, taxation. And what I think they'll do is I think they'll means test it. in reality, right? So high-income earners like myself are not going to get the full benefit, even though I paid in there. They're going to have some way to reduce my benefit, means testing, or they're going to increase my tax. And one of the proposals, which was been put forth before, is to keep raising the income that gets taxed to funnel in there. So right now you're capped out at about $150,000 or so that you can get taxed on, even if you earn $400,000. So in Biden's budget proposal last year, anybody that earned over $400,000, you would start paying Social Security tax above $400,000. That was one of the proposals. I don't think that's going to pass, but I think that number will go up to about $200,000. You have to keep paying taxes in. So that's the way to solve it. And then the younger generation will backfill it. So we have a gap of about 25 to 30 years that it's going to need some help, and then it'll backfill itself. Now, what we ought to do is actually take some of Al Gore's advice and put that money in a locked box, right? Buy U.S. Treasuries. We need somebody to buy our debt at higher interest rates, and there we go. So now we have Social Security monies invested, earning great money with a good credit risk from the U.S. government, and the government gets the money it needs. Solved. Oh, wait, that's logic. Politicians don't want to hear that stuff.
Well, listen, so the takeaway is Social Security, just don't put all your eggs in that basket. All right. That's one reason to get the report card, the comprehensive review of your financial situation. Or if you just want to dip a toe in the water, call and schedule a 15-minute phone conference with one of our licensed advisors. The inflation guide, of course, is there. All of those, no charge, no obligation, 402-369-7777. And don't forget about the next round of estate planning workshops, Wednesday, February 15th, or Thursday, February 16th, 6:30 p.m., right here at the Midwest Learning Center at Retire Smart. 402-369-7777. David, bring us home.
Folks, have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.